Hi, people. Thank you for stopping by at Building Wealth with Rajiv. Here's my chat with Brian Feroldi. Many of you would know Brian. He's one of the most authentic financial educators I've come across. He spent down all his wisdom in his new book, Why Does the Stock Market Go Up? Now, Brian and we talked about a couple of things. Obviously, about his book. Number two, how is he managing through the current crash, and what can you learn from him? What was his experience with 2008 bear market, and what's his favorite pick for 2022? I would strongly encourage you to hear the interview and comment. First 5 comments will get Brian's books from me. That's my promise. Now, if you like my content, please follow my channel. Help me build the community. Hey, Brian, thank you so much. Pleasure to see you again. And, thanks for giving time.
It's a pleasure to be back. Good to see you, my friend.
Yeah. Your book, I think let's start with it. I'm excited. So why do stocks go up? That's your book, isn't it?
Yeah, my book is titled "Why Does the Stock Market Go Up?" Because mainly I titled it that because that was a question that perplexed me for years. Even after I started to buy and sell stocks, I never fully understood why the entire stock market was this magical thing that seemed to defy the laws of physics, right? The thing I was always taught growing up was what goes up must come down. And yet there was somehow this magical thing called the stock market that continually went up. Sure, it crashes on occasion and it goes down hard on occasion. Yet if you look at the long-term history of the US stock market, it goes up about 10% per year and has for well over 100 years. And I was like, that just doesn't make any sense. Doesn't make any sense to me how that's happening and why that's happened. And before I really understood that, whenever the market would crash or go through a bear market, my natural instinct would be like, well, that's it. Capitalism, it had a great run, but it's over, right? Everything's going down. And I couldn't understand why the stock market would eventually rebound, why it would eventually go back up, even though many of the gurus that I followed always said stock crash and it always recovered. It never made sense to me as to why. But once I found out the why behind that, all of a sudden I could invest with confidence. And I always wondered, why isn't there a book that explains this? Like, this really simply explains why this happened. And there was no book. So I said, I guess I'm supposed to be the one that writes it.
We have plenty of declines and price declines these days, Brian.
Yes.
How are you looking at that?
Yes, the last year has been very interesting. Let's say my portfolio has certainly underperformed. And again, because of the psychology of the markets, my style of investing, growth stock investing, was very much in favor in 2020, and returns zoomed up. And that style has gone out of favor over the last year, even though many of the companies that I own and I hold have become stronger over time. So their businesses have become more profitable than they were previously. But that's where the psychology of the markets come in. And having the results go in one direction is one thing, but how the market interprets the results is really what controls stock prices in the short term.
So how are you managing it? What are you doing about it?
I am, like always, learning as I go. One thing I love about the stock market is it's an endless lesson machine for teaching you what to do and what not to do. But fundamentally, nothing that I do or my views on the stock market or the long-term performance of the market haven't changed at all over the last couple of years. I still fundamentally believe to my core that the best place for me to put my capital in the long term is the stock market. And I just accept that as a fee for participating in the stock market. On occasion, the stocks that I hold are going to decline, and they're going to decline rapidly, and it's going to feel awful. That's just the price of admission to investing in the stock market. So while it doesn't feel good when that happens, I know that's a feature of the stock market. That's not a bug.
But it's not the first time you're looking at this, Brian. I think you talked about it in your book as well. You've gone through a couple of crashes already. I mean, you kind of a seasoned person in terms of crashes, isn't it?
Yeah, so I started investing in 2004, which was, of course, right before the Great Recession, which was one of the most horrific bear markets of my life, hopefully. So that was an interesting experience. And of course, the crash of 2020 was also very interesting to live through, although that one was far more short-lived. But if I could briefly go on a quick aside. So when I graduated from college, I worked for a startup medical device company. And when I joined the company, we had no product, no revenue, and we were purely funding ourselves by burning venture capital. So that was the stage that we were at. A few years later, in about 2000 and 2006, the company needed capital, so we went public. The company did have some revenue at that point, about $10 million. And we came public at a market valuation of about $500 million. So we were trading at about 50 times sales. Well, our market, the market really liked our stock. And over the next couple of months after it came public, it traded from about $15 per share up to about $27 per share. So our valuation went from 50 times sales up to about 70 times sales for no reason. It's just like the market was into our story and into growth stocks. And it felt great at the time. Well, that was 2007. And then came 2008 when the world was falling apart and nobody wanted to own money losing businesses. So the company I was working for saw our stock price in 2007 go from $27 per share to under $3 per share by 2009. So it was an 18-month period, roughly an 18-month period, where I saw the value of my holdings in my company fall by 90%. 90%, even though the underlying business did nothing but continue to improve. Our revenue continued to go up. Our margins continued to improve. We gradually added on more customers. We expanded geographically. The business itself was getting stronger and stronger and stronger, but our stock price still fell 90% peak to trough. So that was horrible to go through, but it was a wonderful learning lesson about how the fundamentals of a business don't really matter in the short term. The only thing that matters in the short term is market sentiment. Now, I'm happy to say that the company continued to improve, continued to get more revenue and better margins and et cetera, and it has recently become profitable. And the stock today, the last time I looked, was about $260 per share. So even if you bought this company, even if you bought the company I worked for at the absolute worst time in 2007, you've earned about 9x your capital. And if you bought it any time during that horrific decline, you've earned many multiples of that. So that just has built my resolve that in the short term, human emotions, market conditions, human psychology, that's all that matters. But if you find a company that substantially grows its revenue and its margins and its profits over long periods of time, that will ultimately be reflected in the stock price.
This is amazing, isn't it? I mean, living through that hell sometimes with the price declines, it's not an easy thing. Looking through the red numbers every day can screw you up. Anyway, yeah. 2008, you lived through that, and you're living through 2021 or 2021, 22. What parallels do you see, Brian, there?
So that's a good question. So in 2008, I was an individual investor back then. I was primarily investing in mutual funds, although I was picking stocks at the time. And it doesn't matter what you bought in 2008, right? It doesn't matter what part of the market you were in, what your investing style was, what you went after. Everything went down. Absolutely everything went down and went down hard. And I think peak to trough, the Dow Jones fell 60-ish%, the S&P 500 around that number, the S&P 500, the NASDAQ even a little bit more. So the market conditions back in 2008 was that sell everything, right? It doesn't matter. The numbers don't matter. Everything is going everything is going down and everything's going down hard. That psychology or that feeling, I would say, was pretty similar to what would happen in February of 2020, when the markets, peaked, and then COVID really start to take over. And for about 4 weeks there, it was similar, right? And no matter what you bought, no matter what you owned, it was going down in price. If you look at what's happening today, we're seeing much more of a bifurcation of the market. The indexes themselves more recently have declined, but many growth stocks, many tech stocks, many biotechnology stocks that were doing extremely well in 2020, they have been crushed over the last year, down 50, 60, even 70% during the same period when the markets overall have continued to deliver actually strong returns. So what we're experiencing, what I've experienced over the last year is feels different than it did in 2008 and it did in 2020. But that's also the market behaving kind of normally. If you look back at even the last 20 years, there have been numerous periods when the market was kind of fleeing risky, high growth, high beta stocks in favor of, say, bank stocks or energy stocks or real estate stocks, right? Things go in and out of favor in cycles beyond the overall market cycle. So I will say that it's the last year or so has been a very weird time to be an investor.
And then one thing which keep occurring to me, and I think you talked about it in the book as well, the crash. Why do these crash happen? What's the reason?
Yeah, well, you have to remember that the world is unpredictable, right? And if you look back at some of the biggest crashes in stock market history, there's usually a reason for it. There's usually some macro event that leads to the crash. So in the 2008 stock market crash in the U.S. was caused by the financial crisis and the housing crisis and banks using derivatives to essentially blow themselves up, and the government needed to come in. That makes sense to me, that in that environment, stocks were crashing. In 2020, it was obviously caused by COVID, when the world all of a sudden went from COVID as a minor news story to COVID is the only story that matters, and businesses are shutting down, and it was a very scary time. So it makes sense to me in that market that it crashed. The 2000 crash, that was the fallout from the dot-com crisis, and then you throw in on top of that the attacks on America on September 11th. It makes sense why stocks were down. And if you look back through history, it's typically been wars or financial crisis or economic shocks or oil embargoes, et cetera. All of them lead to mass changes in investor psychology. Investors go from being optimistic about the future and bullish to being pessimistic about the future and bearish. And when human psychology changes, it changes in a hurry, and people go from being very excited to wanting to own stocks to being extremely fearful and wanting to sell stocks. And when that psychology shifts from bullish to bearish, that's why markets crash. That is what controls the stock market prices in the short term, and that history is very clear on that.
But have you addressed the importance of macro in your book? I mean, have you highlighted, because look, I'm not sure, but what people I know, and I've been talking to Brian, a lot of people did not expect the extent of this bloodbath, at least in 2021 and 2022. So that raised a question in my head about what to do. And, I know it's a bottom-up approach, is, the companies need to be strong and fantastic revenue growth. But what does it say about the importance of macro and knowledge about macro?
Yeah, so if you look at again, my book is titled "Why Does the Stock Market Go Up?" and the stock market implies macro, right? It's a macro thing. It's not a micro thing. So yeah, there are macro forces in place that do drive the stock market and the underlying returns of the stock market over time. So I completely talk about that. I also it's really important for investors to understand the psychology of other investors and really the sources of market crashes. And what's so interesting about studying markets is when markets crash, and bad times come, it's awful to go through. It feels terrible at the time. However, those crashes often lead to harsh economic conditions. And what's so fascinating about humans is when harsh economic conditions arrive, that's when innovation really accelerates. That's when companies are willing to adopt and try new business practices. That sows the seeds for the next round of bull markets, because when markets are crashing, people are more desperate to adopt new business models, start new businesses, try new business practices, change the way they're doing things. I mean, look at the most recent one. How is business done today versus how was business done in 2019? I mean, how many, I know so many people that now, but prior to the crash, they were 100% in person at the office, and now they're 100% remote, and they will likely be 100% remote indefinitely. And that has caused businesses to radically shift so many of their practices. And that, I believe, is going to set the stage for the next leg of the bull market and strong economic activity. So that's what's so fascinating about crashes, is they feel awful when you're going through them, but they actually often spur and lay the fertilizer for the next round of economic growth.
This is brilliant, Brian, the way you've summarized it. It gives me some confidence. It puts me at ease. Thank you for that. Anyway, now I'm glued to stock prices sometimes. Am I doing the right thing? No, right?
It depends. So like you, I used to, when I first got involved in investing, I used to check stock prices every day, multiple times a day, and nowadays it's even easier to do so because we're all walking around with smartphones. Yeah. And I don't know, like my iPhone comes pre-installed with an app called Stocks on my home screen, and I push stocks and it comes up and it shows you what's happening with the market, what's happening with a whole bunch of stock prices. So it's never been easier for us to access what's happening to stock prices. But that's information. And if you're going to invest, the only way that I know how to invest successfully is over long periods of time, right? Anything can happen to stocks in the short term. And I know that for myself, my own history with trying to time stock prices, with trying to time the market, I'm terrible at it, right? I thought if you were to ask me, when is the market at a peak? I would have said December of 2017. I thought in 2017, the market had gone up for 7 years in a row. It just had a big run. And I was like, prices are crazy. So if I was a market timer, I would have sold everything in 2017 and in the hopes of getting in. Well, how stupid would I be looking today if I actually went through with that? The market has been straight up since the end of 2017, and I would have left enormous gains on the table if I tried to time the market. So when it comes to looking at stock prices, I look at my portfolio a few times a month, and I don't look at stock prices every day. In fact, I only know that my stocks are really moving dramatically in one direction or the other. Typically, when somebody direct messages me on Twitter or sends me an email and they're like, "Why is ABC stock down or up today?" And I'm like, I don't know. I don't even know it was moving, but I don't think there's any right or wrong answers to how often should I check my stocks. But I will say, if you're checking your stocks often and they're causing you pain, and you want to make changes to your portfolio, and your psychology is to do things historically that you don't want to do, then maybe you're checking them too often. But everybody's different.
Yeah, no, I think it makes sense. So, what are you trying? Are you trying to tell me that that whatever we are witnessing now, these corrections or crash, whatever you call it, it will reverse someday?
That's my expectation. I mean, I always get back to the fundamental drivers of what create value and why stocks have value. So the stocks have value because the businesses that underline them attract customers, create new products, grow their revenue, enhance their margins, and increase their profits over time, period. If the companies that I buy and the companies that I'm invested in can do that successfully, eventually their stocks will be rewarded over time. If they can't do that successfully, their stocks will flounder and fall over time. But what happens to the price of the stock at any given time is irrelevant to the actual functioning of the business. And again, go back to that stock, that story I told at the beginning. I worked for a company that went from 27 to 3, and we were a better business at 3 than we were at 27. Think about that. We had 18 months of progress, of success, of demonstrated track record of growth, and yet the market said you're worth 90% less now than you were previously. But what ended up happening ultimately was the value of the business came through. The market eventually came around and recognized that the growth that we had, and the stock price rebounded. So I don't try and learn lessons from what stock prices are doing, because that's more an indication of sentiment at any given time than it is about recognizing the underlying fundamentals of a business. However, if a stock I own is rapidly declining, and there are also clear signs that the underlying business is rapidly declining, or the moat is under attack, or the management team isn't trustworthy, or something like that, that's when I would actually take notice and get worried and think about selling.
That makes sense. And Brian, how often does stock market go up? I mean, it goes up and down, but how often does it go up? Is there statistics on that? I mean,
yes. So one of my favorite statistics about the stock market is if you judge the stock market over the appropriate time period, the stock market is not a gambling machine at all. And I'm when I'm talking about the stock market, I'm specifically referring to the S&P 500 in the United States. So that's the stock market that I know best and I study the most. And one of my favorite studies that's ever come out is just you look at what the odds are of earning a positive return in the stock market according to your holding period. If you buy the S&P 500 and hold it for 1 day, your odds of making money are about 51%, and your odds of losing money are about 49%. So it's slightly better odds than a coin flip. Well, what happens if you buy stocks, the S&P 500, and you hold for 1 month? So you increase your holding period from 1 day to 1 month. In that case, you have made money historically in real terms. So this is after accounting for inflation, 61% of the time. So you go from a coin flip to being right 61% of the times. How about if you hold for 1 year? So you buy the S&P 500 and you hold it for 1 year. Your odds of making money are 69%. How about 5 years? 81%. How about 10 years? 89%. And my favorite number of all is 20 years. If you buy the S&P 500 and you hold it for 20 years, you have made money in real terms 100% of the time. Doesn't matter the day, doesn't matter the hour, doesn't matter the time you buy. If you buy the stocks, US stock market, and you hold for 20 years, you have made money in real terms 100% of the time. So when people say the stock market is risky, I say, no, the stock market isn't risky. What's risky is not holding stocks for the appropriate time, the appropriate amount of time. So when I see things like that, it makes me happy that I have the vast majority of my personal net worth in the U.S. stock market. And you understand why people like Warren Buffett, Charlie Munger, and more do too.
Yeah, now I think it makes sense. Now, this is wonderful, Brian. I think these kind of statistics, they kind of put, in these troubled times, they kind of act as a refresher of, that, to do the right things. Now, these are troubled times in some ways. How to avoid the multi-million-dollar mistake? I mean,
Say that one more time.
How to avoid a multi-million-dollar mistake? How to avoid an expensive mistake in these times?
Yeah, well, when I look back at my own history with investing, all of the most expensive, all of the worst mistakes I've ever made, all contain the same word: sell. That's it. Every expensive mistake that I've made in the market typically involves me buying some asset that I have a very high conviction in, that I think is going to do well, and then for whatever reason I chose to sell that asset that then went up in value. I've sold stocks that are up 10, 20, even 50 times in value from when I sold them. And if you think about it, that the lost wealth that I had from selling those stocks that went up dwarfs the losses that I've had from buying bad stocks that then went down. And this is just the wonderful math of investing. If you buy a stock, the worst you can do is minus 100%. I've never even done that. And I've bought some terrible stocks. The worst I've ever done is like minus 80 or 85%. So you invest $1,000. Worst case scenario for me so far is that $1,000 gets whittled down to about $150. Bad, right? But conversely, if you buy a great stock, you can turn $1,000 into $10,000, $20,000, $50,000, $100,000, right? So if you can get just a handful of those mega winners into your portfolio, the gains that you will have from those stocks will dwarf all of the losers that you have combined. And by the way, that's exactly how the stock market works. If you crack open the total stock market index or the S&P 500, it's a minority of companies, just a handful of companies that deliver such extraordinarily high returns that it more than covers all of the internal losses of the losers of the index, the losers that do nothing or they go down. So it's getting those extreme winners in your portfolio that really is all that matters. And that's why indexing and buying index funds is such a time-tested strategy, because yes, you're owning all of the losers of the market, but you are guaranteeing yourself that you'll get those those small minority of stocks that drive the lion's share of returns, which is why buying into index funds is such a fantastic strategy. But to answer your question, the multi-million-dollar mistake that you can make is if you have a multi-decade time horizon. If you're investing today with the hopes of using this money in retirement, and you take that money because you're scared or you're fearful, and you put it into CDs or cash or an instrument that does not perform as well as stock, that is in many cases costing you millions of dollars in the long term, simply because you're worried about the short-term volatility.
So what I'm hearing is that individual investors have, not all individual investors need to go for stocks. Indexing is one of the ways to go forward.
Yep. Oh, totally. When people ask me in my normal everyday life, what do you recommend investing in? My answer is always index funds. Index funds are super simple. They're low cost. They're tax efficient, and they have a extremely high likelihood of doing very well over time. So index funds plus dollar cost averaging is all you need to know for the average person to do very well in the stock market. However, if you are the type of person like me that for whatever reason are interested in business, are interested in stocks, like the research process, I think adding in individual stocks on top of your index fund exposure can be a viable strategy to creating wealth in the long term. The reason I don't recommend that to most people is because most people are bored to tears by the prospect of researching a company and figuring out how to invest and battling their own psychology, and just investing in general is a subject that bores them. But if you're in that minority of people that actually is energized by research and enjoys connecting with other investors and learning, I think individual stock picking can be a great skill to learn.
Yeah, awesome. Now, I think you've this you're phenomenal at simplifying things, Brian. I think, and you probably, some other people may have told you as well. Now, if I'm an individual investor and want to buy a business, how do I determine the business worth? I think just simple couple of lines. What's your direction?
Yeah, so valuing a business, coming up with a number to put on a business is a very tricky thing, and it's far more art than it is science. And one of the biggest lessons that I've learned after buying individual stocks is just how hard valuation can be. If you talk to many of the investment gurus, or if you go through an MBA school and learn how to invest and value a business, one of the classic answers that they'll give you is a discounted cash flow model. So that's when you take the future, you predict the future cash flow of a business out in perpetuity. You take those numbers and you discount them by some rate that you come up with back to today's, and that gives you a precise value for what that business is worth at any given time. That's one way to value a business, and that's not a way that I actually use myself, and not because I don't think they have value and that technically they are correct, but I think that making any long-term predictions about exactly what the revenue and the profits and the margins are going to be for a company is an exercise in fooling yourself into specifics with fancy math. Ask any person that did a discounted cash flow analysis in 2019 what that company was going to earn in 2020. Would their models have incorporated COVID? Of course not. Would they have incorporated the great financial crisis if they were doing that in 2006? Of course not. Right? The world is so complex and so unpredictable that oftentimes discounted cash flow models don't really fall down to actual real world scrutiny. But if you're the type of person that likes to use them, I say go for it. My preferred method to value stocks is to just look at very simple multiple metrics. So the price to sales ratio, the price to earnings ratio, the price to cash flow ratio, the price to gross profit, et cetera, and use those as a rough proxy for about what the value of the business should be worth, and use those to really guide my investing decisions. But valuation is, as I said, is far more of an art than it is a science.
Yeah, no, I agree. I think I'm kind of in a aligned to your school of thought, but it's a personal decision. Now, I think I have three more questions, Brian, or three or four, about your investment philosophy and two about your book. Now, the prices, I know you're a growth investor by nature, Brian, and are you adding to your positions these days, or you're just watching on the sidelines?
Yep, my general style is to continually add money to my portfolio, and I have a huge watch list of stocks that I own and that I want to potentially own. And at any given month, when it's time for me to add capital to my stocks, I typically run through my checklist and look for the highest combination of business quality, long-term potential, and valuation at any given time. And I kind of try and pick and choose what stocks best fit that criteria, and continually add those stocks to my portfolio. So I'm a buyer of stocks in all markets, and since I don't plan on retiring for many decades from now, I plan on being that way for years, if not decades to come.
Nice. Now, I know you have a list of growth stocks you talked about in 2022. Favorite 10 growth stocks. I want to make your life a little bit difficult. Can you pick one for me?
Pick one stock?
Yeah. 2022. What is like, I know your video, I saw that a couple of you and other, brands stuff that it. Things have changed a bit, but I'm sure you're a long-term investor, but just one, just for the sake of fun and knowledge.
Sure. Just for the sake of fun, one stock that I like a lot that has been dramatically underperforming recently, but checks a lot of the boxes that I look for in a strong business is Fiverr International. So the ticker there is FVRR. This is a stock that I recently added to my portfolio again. And again, if you want to look at an interesting look at psychology, Fiverr stock currently trading at $83 per share. Its market cap is about $3 billion. This stock is down almost 70% from its 52-week high of $336 per share. So this was a go-go growth stock in 2020. Everyone was convinced that consulting and Fiverr's platform was going to grow to the moon. More recently, we've seen LinkedIn take a shine to the space. Upwork has been competing well, and combined with the overall malaise and growth stocks, this stock has been hit very hard. But I continue to believe that Fiverr's platform has a tremendous runway for long-term growth. It's still founder-led. It's got great margins. It's profitable. It's free cash flow positive, and I see signs of optionality. So, given its $3 billion market cap, this is a stock that I recently bought, and I'm bullish on its future.
I was secretly hoping you would say C Limited, but it's fine. But it's fine. I think
another great business.
Yeah, I know. That's, how much is that fallen? A lot of shit going around about the business. When the price goes down, nobody likes the business. When it goes up, it's a beast.
Right.
Now, last question: where to find your book, and when is it coming?
So the book is currently available for pre-order on Amazon, and depending on what country you're in, other retailers also available on like Barnes and Nobles. It's in the pre-order stage right now. It will be shipping to people on April 5th, but we're still working through the logistics for international shipping and all that kind of stuff. And it will be available on Kindle. I've been asked a bazillion times, is it going to be available on audiobook? The answer there is yes, eventually. I don't know the exact timing of that, but it was written to also be eventually converted over to audiobook. So I am super excited to get in people's hands and actually to get real world feedback on it.
Awesome. And I think that's it, Brian. You answered all the questions, and very timely interview, very timely book. Wish you all the best for the book, and you've been a great educator. I'm sure the book will succeed. So thank you so much.
Thank you, Rajiv, for having me. It's always a pleasure to be here.